we were very bullish, a couple years ago. We moved more bearish this year, which turned out to be the right call. But what we're looking at is the fact of, okay, what really has changed over the last few years? And ultimately, it's nothing. I think it's more narrative based. You've seen sentiment here in the U.S. around Chinese companies fall quite a bit. But that's really it. So the fundamentals of these companies is still sound. So we are looking for the right time for us to get back in. And we're talking about primarily the big players, your JD, Baba, Baidu, and Tencent. So we're looking for that entry point. We've been negative, but like you just said, valuations, there is a point where you just can't deny valuation. So I think, to view this as a time to start to at least build that portfolio back up seems like at least somewhat of the right time to do that. I don't think you want to go all in here because there will be continued volatility. But like I said, when you look at the
when
fact
you
that
say
this is
not
really
all in, how much would you allocate to China right now? It's still 34%
So,
of the
I mean,
MSCI EM index. People forget that. Like the underweight position,
yes.
the peak pessimism, I think is a bit overdone, no?
Yes, I would say to be underweight is overdone for sure. And so if you're looking at emerging markets, I think you want to be right there with, equal weight. What we're looking for is that opportunity to take on risk and to add to that position above equal weight. So I think if you're underweight, you want to be at equal weight, and then you want to hold there for a little bit. And then if you see any dips, add to it. But ultimately, I think by the end of the year, you should be quite a bit overweight China relative to the rest of our emerging markets.
But is this as a short-term tactical trade, or is this as a long-term trade? Because I know, Speaker Johnson did nix the idea of tacking on the investing into high-end China tech when it comes to the latest defence bill. But they're going to be circling the wagons on this again, because there was a little bit of resistance coming through from the Finance Committee. But they're going to be circling the wagons on this again at the start of Q1, and you would have to imagine that all of those companies that you mentioned, barring maybe Tencent, all have AI ambitions, or have ambitions that would necessitate them being in industries that can't necessarily be invested in on the insto side in the US. So where's that money going to come from for the upside?
Yeah, I mean that is a tough question. That's why we're, like I said, staying equal weight right now. I do think that there's enough money globally that can move in. Now, the velocity of that, I think that'll be a little bit slower than what you would see out of the U.S., which is why we're saying, make sure you're at least equal weight right now, but look for that upside. Ultimately, this is a long-term play for us. If as we're adding back China into our portfolios, we've long held that we think over the next 10 years, China will outperform U.S. markets. Now, the timing of that and the volatility around that is what's more difficult, which is why we moved to underweight prior, and then, like I said, moving to equal right now. So we do think this is going to take a while to play out, and how it actually plays out is difficult to see. But like I said, you can't get past the fact that these are very good companies with tremendous cash flow, and the valuations are just on sale relative to their U.S. counterparts. So when you're looking at just being a fundamental investor, you can't deny companies like Tencent or Alibaba.